Picture this: two duplexes, same street, same price, same year built. One owner calls a cost segregation firm, the other doesn't, because his brother-in-law told him cost seg is only for the big commercial guys, and he didn't want to poke the IRS for no reason. Guess which one just wrote a check for $40,000 more than he had to? That's not a hypothetical because strategy failed somewhere. That's a hypothetical because a rumor won. A rumor beat a legitimate engineering-based, fully defensible tax strategy, not because someone checked the math, but because nobody did. If you own real estate and you've talked yourself out of cost segregation, not because you ran the numbers with your tax professional, but because of something you heard at a meetup or a Facebook group or from a guy who read one blog post 3 years ago, this is the episode where we go through every one of those reasons, one at a time, out loud, and you decide for yourself with actual information whether they're still standing by the end. I'm not going to tell you that cost segregation is right for everyone. It isn't. But I am going to tell you that most of the reasons people rule themselves out have nothing to do with whether it's actually right for them. Today, we're going to fix that.
Welcome to the Tax Strategy Playbook, the show where smart investors, business owners, and real estate pros learn how to win the game the IRS wrote. Each episode, we break down powerful strategies, expert insights, and real-world examples that help you keep more of what you earn. Because here, it's not about working harder, it's about working smarter with your taxes, because tax evasion is a crime, but tax avoidance is mandatory.
Welcome back to the Tax Strategy Playbook. I'm David Wiener, Mr. Cashflow, and I've spent my career helping real estate investors, business owners, and tax professionals who work with them to keep more of what they legitimately earn, legally, on purpose, with a plan instead of a shrug. Here's the promise for today, and I want to be specific about it because learn about cost segregation isn't a real promise, it's a topic. By the end of this episode, you're going to be able to do 3 concrete things. Number 1, you're going to be able to name the 5 myths that talk people out of cost segregation before they ever look at their own numbers. And you'll know which ones are just flatly wrong and which ones have a real smaller kernel of truth buried inside them that's worth respecting. 2, you'll know the actual qualification line in plain dollars that tells you whether this entire conversation even applies to your property. Not a vague, it depends, an actual number. And 3, you're going to walk away with the exact question to bring to your tax professional, worded in the way I'd word it if I were sitting across from you. Not someday, this week. That's the trade. 40 minutes of your time for a decision you can actually act on, instead of a decision that got made for you by whatever you happen to overhear. Let me tell you exactly who I built this episode for. If you're a real estate investor, long-term rental, short-term rental, doesn't matter which, and you've got a property with real money sitting in it, this is squarely for you. If you're a business owner who also happens to own the building your business operates out of, or a rental property on the side that you don't think about as real estate so much as that place my brother-in-law lives, same thing. This isn't just a landlord episode, even though it'll sound like one for the next 30 minutes. And if you're a tax professional listening to this, stick around because I'm not going to spend the rest of the episode telling you things you already know. I'm going to walk you through the specific myths that your own clients believe in the exact language that they use when they tell you no to a study they should be saying yes to. You're going to want the phrasing because half of this job is knowing how to answer the objection before it fully forms. Here's why I'm doing this one now and not, say, 18 episodes ago. I get some version of the same conversation almost every single week. Somebody sends me a property, I run a free estimate on that property for a cost segregation study, and the deduction is real, it's meaningful. It's the kind of number that actually changes what somebody owes. And then I hear the pause. And then I hear the reason for the pause. And the reason is almost never, I ran this by my CPA and the math didn't work out. The reason is almost always something somebody heard secondhand at a meetup, in a comment section, on Reddit, on TikTok, from a friend of a friend who did one deal once. So today's not a new strategy. It's actually the opposite of a new strategy. It's clearing away the 5 pieces of bad advice standing between you and a strategy this show already walked through back in episode 2, when we first laid out what cost segregation and bonus depreciation even are mechanically. If you haven't heard that one, don't worry. This episode still stands on its own 2 feet, but I'd recommend going back and watching that one too. Today, we're not going to explain the mechanism from a blank page, though. We're going to take a crowbar to the reasons people talk themselves out of using something they probably already heard of. So let's start with the myth that does the most damage of all 5, because it's the one that stops people before they ever get to the second one. Myth 1 is cost segregation is only for big commercial buildings. This is the gatekeeper myth. It's the one that stops people before they even ask a second question. Because if you believe this one, none of the other 4 matter. You've already closed the door and walked away from it. Here's the actual line, and I want you to actually remember the number, not just the vibe of the number. $150,000 property cost basis. That's the threshold where an engineering-based cost segregation study is generally worth running the numbers on. Not the purchase price, the cost basis, which usually means your purchase price minus the value of the land underneath it, plus whatever capital improvements you've put in place since. And here's the part that actually kills the myth. It applies across residential long-term rentals, short-term rentals, commercial, industrial, all 4 categories, not just one. I want to say that again slowly because it's the entire myth collapsing in one sentence. This is not and never has been a commercial-only strategy. Picture, purely as an illustration, a single-family rental somebody bought for $200,000. Hypothetical, not a real client, just a round number to make the math easy. That property can clear the basis threshold without even breaking a sweat. A short-term rental can clear it. A duplex can clear it. A little 4-unit building somebody picked up because it was a good deal on a Tuesday can clear it. So if somebody ever tells you that cost segregation is only for the big guys, here's the one sentence to remember and repeat back to them, word for word. Cost segregation isn't a red flag for being too small. Believing you're too small is the actual mistake. Now, quick pause, because I promised you I'd give you a moment here to actually follow along instead of just sprinting through vocabulary. So let's define the mechanism properly, because cost segregation gets thrown around like everybody already knows exactly what it means. And honestly, most people sort of know and sort of don't know. They know it's good, and they know it involves depreciation, and in general, that's where it stops. When you buy a rental property, the IRS's default assumption is that the entire building depreciates in one slow, uniform, straight line. 27.5 years for residential property, 39 years for commercial and short-term rentals. Same deduction every single year, no matter what's actually happening inside that building. But here's the thing. A building isn't actually just one object. It's a roof, it's carpet, flooring, it's cabinets, it's countertops, it's a parking lot, it's electrical wiring feeding one specific outlet in one specific wall. Some of those components genuinely wear out and genuinely get replaced on a 5-year clock or a 7-year clock or a 15-year clock. Nobody's carpet lasts 27.5 years. Nobody's parking lot either. So cost segregation is the process where a trained professional actually walks the property. Engineers carefully review the photos, detailed plans, and cost documentation, and reclassifies those individual components into their real shorter recovery periods, instead of letting the whole building get lumped into that one long bucket. That reclassification is what unlocks bonus depreciation on a meaningful slice of the building right up front in the early years you own it, instead of the deduction just kind of trickling out over almost 3 decades in tiny, absolutely forgettable increments. Here's the phrase I want you to actually hold on to, because it's going to matter a lot in about 5 minutes. Engineering based. Say it exactly like that when you talk to anybody about this. Your tax professional, a cost segregation firm, anyone. not a 5-minute online calculator, not a spreadsheet estimate somebody eyeballed, an actual engineering-based study. That phrase is doing all the defensive work behind myth number 2, which is coming right up. And look, I know this is the part of the episode where it would be easy to kind of zone out because recoverable periods and reclassification sound like homework. Stay with me here, because this mechanism is the entire foundation that everything else in this episode sits on top of. If you don't have this part, the rest of the myths won't make sense when we knock them down. Quick ask before we keep going. If this is useful so far, hit follow or subscribe right now on your podcast platform, on YouTube, or at taxstrategyplaybook.com, wherever you're listening. It costs you exactly one tap, and it means the next one of these lands in your feed automatically instead of you having to remember to come back every week. I'll give you the most expensive version of this particular myth I've seen personally play out, and I'm changing enough of the details that nobody's getting identified here, but the shape of it, the actual arc of the story, is real. This is the kind of thing that happens way more than most people think. Picture an owner who has 4 short-term rentals, each one he bought for right around $350,000. That's an entirely hypothetical composite number, by the way. I'm not describing one specific client's actual purchase price. I'm describing the kind of number that shows up consistently in my business. Bases on each one of these 4 properties comfortably north of the $150,000 line we just talked about. 4 separate properties, 4 separate studies that would have qualified easily without anyone stretching to make the math work. He didn't do a single one of them. All 4 sat on the standard straight line schedule year after year. Why? Because somebody at a real estate meetup, somebody with no particular authority to be handing out this advice, by the way, just a guy at a meeting, told him cost segregation was for people with apartment complexes. He owned houses. So in his head, that filed the whole conversation under not for me. And he never asked the question again. Not to his CPA, not to anybody. The deduction he left on the table across all 4 properties combined in year 1 alone was well into the 6 figures. I'll say that again because it deserves to land. 6 figures gone. Not because the strategy didn't apply to him, it absolutely did apply to him, but because he never tested that one sentence he heard against his actual numbers. That's the real cost of a myth. It's not a strategy failing somebody. It's a strategy nobody ever gave a chance to fail or succeed because a rumor got there first and closed the door quietly without anybody noticing it had even closed. Okay, that's myth number 1, and it is the biggest one of the 5 because it's kind of the gatekeeper. Everything else we're about to cover only matters to somebody who's already decided the door might actually be open for them. So if you take nothing else away from the next 20 minutes or so, take the number $150,000 in basis across 4 property types: residential, long-term, short-term, commercial, industrial, not just the big commercial deals. If you've made it this far with me, you're exactly the person this show is built for, and I want to actually hear from you instead of just talking at you for 40 minutes. Go to taxstrategyplaybook.com/newsletter and subscribe to the newsletter. It's free. It comes with access to other resources and my current 2026 tax planning guide. And when you sign up, reply to me with one word: basis. Just that one word. If you don't already know your basis on the property you're thinking about, that word is your answer. And it means step 1 for you this week is calling whoever prepared your tax return and actually asking them, what is my basis? All right, myth 1 is down. And hopefully that number, $150,000, is sitting somewhere in the back of your head now. Let's move to the myth that scares people the most, even the ones who already believe they technically qualify. Myth number 2 is this is an audit magnet. This is the myth with the most fear wrapped around it, so let's actually take it seriously instead of just waving it off with a slogan. Here's the honest version of this, because I don't want to pretend there's zero truth anywhere near it. There is a version of cost segregation that raises real, legitimate scrutiny with the Internal Revenue Service. It's the version done with a generic online calculator or some percentage rule of thumb that somebody pulled out of the air. No engineers involved, no actual physical site visit, no plan review, no defensible methodology sitting behind the final numbers. And if you've done one of those and you didn't get audited, congratulations. Just wait. It could happen. That version deserves to be a little bit scary, and it should raise an eyebrow because if I were reviewing that return, it would raise mine. But that's not what an engineering-based study is. And this is the distinction the myth completely erases. A properly done study documents its own methodology from the ground up. It ties every single reclassified component back to actual cost records or a physical inspection of the property, and it stands behind its own numbers, the exact way any other legitimate accounting position on your return does. The risk was never the strategy itself. The risk was always the shortcut version of the strategy, the 5-minute version, the cheap version, not the real one. Let me put it a different way, because I think this is worth restating until it actually sticks. The fear isn't really about cost segregation. The fear is about a specific, sloppy way of doing cost segregation, and that fear got attached to the whole strategy instead of just the shortcut. That's how myths work, generally. They take something true about the worst version of a thing and quietly apply it to every version of the thing. Now, let me actually play devil's advocate here for a second, because a script that only argues one side of this isn't teaching you anything. It's just cheerleading. Here's the strongest, most honest version of don't bother that I can build. The study costs money up front, a few $1,000s, sometimes more, depending on the size, the location, and the complexity of the property. That's real money, spent before you've seen a dollar of benefit. And depreciation recapture is real. When you eventually sell the property, some of what you deducted early comes back and gets taxed. And it's often taxed at a less favorable rate than the rate you saved at when you took the deduction. So a genuinely thoughtful skeptic's question is, why front-load a future tax hit onto yourself on purpose in exchange for a deduction now instead of just not doing any of this? Fair question. I want to answer it straight instead of dodging it or minimizing it. Recapture is real. I'm not going to sit here and tell you it doesn't exist, because it does. Episode 17 on this show is entirely built around that exact trap, and it's genuinely worth a listen if this is the specific piece you're stuck on. But recapture assumes one very specific thing has to happen: that you sell the property outright in a fully taxable sale, and you never do anything else with the proceeds. Most serious long-term investors don't actually do that. A 1031 exchange defers the recapture right along with the underlying gain. We covered that entire mechanism back in episode 7. If you want the full walkthrough, and if you hold the property until you pass it on to your heirs, they generally receive a step up in basis which can erase the recapture question almost entirely. That's exactly the territory episode 19 walked through on the estate planning side of things. So here's the honest limit, stated plainly. If your actual plan is to sell this specific property outright in the next few years with no exchange and no intention to hold it long-term or pass it on, sit down and look at the numbers carefully with your tax professional before you assume this is automatically a win for you. Don't just take my word for it either way. But for almost everyone else, the time value of a real deduction today, weighed against the recapture that's deferred or eliminated tomorrow, wins the math. And it isn't particularly close. Myth 3. My tax professional already handles this. This one isn't malicious, and I want to be fair to tax professionals here, because it's not a mistake on their part. It's just a misunderstanding of what a standard tax return actually does and doesn't do automatically. Your tax professional, doing entirely normal, entirely competent, good work, is going to put your building on the standard straight line schedule, 27 and a half years or 39, because that's the default, and that's what a return requires without additional input from somebody else. That's not them missing something. It's that reclassifying components into shorter recovery periods requires the actual engineering-based study we've been talking about this whole episode. And that study is a separate, specific piece of work. It isn't something baked automatically into annual tax preparation, the same way your tax professional doesn't automatically know the roof was replaced 2 years ago unless you tell them. That's why I'm always talking about the difference between tax preparation and tax strategy. So, tax strategy is a look ahead, and most tax strategists are very familiar with these kinds of studies and able to guide you in the right way. Think of it this way, and I think this framing actually clears it up for most people. Your tax professional files the return accurately based on exactly what they've been given. The study is what changes what they're given in the first place. It's not a second opinion on their work, it's new information handed to them which they often can use. So far, we've cleared the myths about whether you even qualify and whether this is risky. Now let's get into the ones about timing, because honestly, this is where I hear the most genuine confusion, and it's where the real qualification and real traps actually live. Myth number 4. I already missed my window. I bought the property years ago. This is one of my favorite myths to bust, honestly, because the fix is so simple that people usually don't believe me the first time I say it out loud. You don't need to have the study done the year you bought the property. There's a specific version of this study called a look-back study, and it lets you capture the same accelerated depreciation on a property you've already owned for years without amending a single prior tax return. The mechanism catches you up in the current year instead all at once, rather than requiring you to go back and reopen old filings. So if you've been sitting on a property for 3 years, 5 years, maybe even up to 15 years telling yourself that the moment already passed you by, it didn't. That moment is sitting right there, waiting. And honestly, this might be the most expensive myth on the entire list, simply because of how many years of missed deduction it can quietly represent by the time somebody finally asks the question. Here's the sentence I want you to actually remember, because it's the one worth repeating back to somebody. You didn't miss the window. The window doesn't close. It just sits there, waiting for you to ask about it. Let me slow down on that for a second, because I don't think the size of it fully lands the first time you hear it. Every year you own a property without doing this study on paper is a year where the deduction you could have taken just didn't happen. It's not saved up for later. It's not waiting in a jar somewhere with your name on it. A look-back study is valuable specifically because it goes back and captures what you missed all at once in the year you finally do the study. But the only way it exists at all is because somebody decided to stop assuming the window had closed and actually asked the question. I bring this up because I talk to people constantly who own 3, 4, 5 properties, and they've owned some of them for a decade. And the second most common sentence I hear right after, I thought this was only for commercial, is some version of, well, it's too late now. I've had it too long. It's not too late. We can go back about 15 years and still make it worth doing. That's the whole point of a look-back study existing as a mechanism in the first place. Myth 5 is this only matters for buy and hold investors. Short-term rental owners hear the strategy described and immediately assume it's a long-term lease-only conversation, something for landlords with tenants and 12-month agreements. It isn't, and honestly, it might apply to short-term rentals even more cleanly. If anything, short-term rentals often see faster depreciating components than a standard long-term rental. More furniture, more appliances, more finishes, more the kind of stuff that genuinely does wear out on a shorter clock because guests are cycling through constantly. And depending on how you materially participate in running the property, how hands-on you actually are, those losses can, in some cases, offset your active income, not just other rental income. That's a real nuance. It's worth an actual conversation with me or with your tax professional about your specific situation. It's not a rule of thumb that you should take from a podcast and run with blindly, But the myth that this strategy is only for landlords with tenants on a lease is simply flatly wrong. Here's the one thing on this list I'm not going to pretend is fully settled, because pretending there's certainty where there genuinely isn't any would be worse than just admitting the edge exists. Exactly how your rental losses affect your other income depends heavily on your level of involvement in the property and on rules that are genuinely fact-specific to your situation, your hours, your role, how the property is used. I'm not going to guess at that exact boundary for you here on air, because I'd be doing you a disservice pretending I could give you a universal answer that fits everyone listening. That's a real specific conversation to have with me or your tax professional, with your own numbers and your own situation sitting in front of them, not a rule I can hand you in the abstract. I want to say clearly why I'm drawing the line there instead of just pushing through with a confident sounding answer. It'd be easy, honestly, to give you a tidy rule right now and let it sound authoritative. But the rule genuinely changes based on facts I don't currently have about you. How many hours you put in, whether you've got a property manager, how many properties you're juggling, do you qualify as a real estate professional with the Internal Revenue Service? Handing you a one-sized answer on something like that isn't teaching, it's guessing out loud with a confident voice. So instead, bring this exact section of the episode to your tax professional. Tell them what you do on a day-to-day on the property, and let them apply the actual rule to your actual facts. That's not me dodging the question. That's me respecting the honest answer your name has attached to it, not mine. And I will always be available for a conversation if you'd like me to run through those facts with you and provide you with an honest answer. So let's do the questions I actually get asked out loud, one sentence each, no hedging. This is the part of the conversation where everybody starts asking their own version of the same thing. Do I need a huge portfolio for this to be worth it? No. If your basis on a single property crosses $150,000, it's worth running the actual numbers, full stop. And I can run a free estimate for you on any property. Just contact me with a few pieces of information. I can let you know what the study would cost and what the estimated tax benefit would be. Will this get me audited? An engineering-based study is defensible. The 5-minute online calculator is the thing that actually raises eyebrows. We've conducted over 65,000 studies across the United States, every type of property, and we have never triggered an audit because a well-done study won't. Can I do this on a property that I've owned for years already? Yep, that's the look-back study. And you don't touch a single one of your old returns to get it. Well, what happens when I eventually sell? Recapture is real, but a 1031 exchange or a hold till transfer plan is already erasing it before it actually becomes an actual problem for you. Does this only work on long-term rentals? No. Most people have heard the term short-term rental loophole, and it's a real thing. Short-term rentals often qualify cleanly, sometimes more cleanly than a long-term rental, because more of the property turns over faster. And the one I get the most, more than all the others combined, is this too good to be true? Nope, it's not. It's just understood and underused, because the myths about it are louder than the math ever gets to be. So here's your playbook. Number one, ask yourself the self-qualifier, honestly, before anything else. Does my cost basis on this property, purchase price minus land value plus improvements, clear $150,000? Yes, keep going. You're in the conversation. If you genuinely don't know the number off the top of your head, that's step one for you. Not a dead end and not a reason to stop reading. Most people can get that number with one phone call. Call me, call your tax preparer. There's no genuine excuse to sit on "I don't know" for more than a week. Number two, bring your tax professional this exact question, worded exactly like this. Would an engineering-based cost segregation study make sense on this property, given my basis and how long I plan to hold it? That's the whole question. If you want more specifics to take it to them, contact me for a free estimate on your property and take that document to your tax professional so that you can talk it over. But say it exactly like that, word for word, if you have to write it down first. It forces the right conversation instead of a vague one. The reason the wording matters is that should I do cost segregation is vague enough to get a vague answer back. The version I just gave you forces your tax professional to actually engage with your basis, your timeline, and the numbers that I can provide for you, which is where the real answer lives. 3, if you've owned the property for years already, and you've quietly assumed you missed your window, ask specifically about a look-back study by that name. Don't let years already owned be the silent reason you never ask the question out loud. Say the 2 words, look-back study, out loud in that conversation. It's specific enough term that it tends to get a specific answer instead of a shrug. 4, before you let yourself assume recapture kills the math on its own, ask your tax professional to actually run both scenarios side by side. Sell the property outright versus a 1031 exchange or a genuine long-term hold. In my experience, the myth dies the moment you actually see both numbers sitting next to each other on paper. It stops being a feeling and starts being math. And arithmetic is a lot easier to trust than a feeling. Number 5, if anything in this episode touched a nerve around rental losses offsetting your actual income, and you're not fully sure how material participation actually applies to your situation, go back and listen to episode 4 on this show when we walk through exactly when rental losses count against your other income and when they don't. Beyond that, feel free to contact me at any time. I'm happy to have that conversation with you, no charge. That episode 4, and this one were built to sit next to each other. So if you only take one bridge away from today, make it that one. That's 5. Write it down. That's your playbook. Last ask of this episode, and it's the only one today that really isn't about you. Think of one specific person right now, an investor, a landlord, a business owner who also happens to own the building they operate out of, who's currently sitting on a property quietly believing one of these 5 myths and losing real money to it every single year that goes by. Send them this episode, not check out sometime when you get a chance. Send it to that one specific person today by name, because that version of sharing is the one that actually saves somebody real money instead of just floating past them in a feed and getting forgotten by tomorrow. That's the show. 5 myths, one number worth remembering, $150,000. One specific question to bring to your tax professional this week, not someday. Let's actually run back through the 5 quickly, because repetition is the only thing that beats a rumor you've heard a dozen times. It's not just for big commercial buildings. Residential, short-term, commercial, industrial, all 4 qualify above that basis line. It's not an audit magnet. The shortcut version is the risk, not the strategy itself. Your tax professional isn't already doing this automatically. The study's separate information you have to go get. You haven't missed your window either. The look-back study exists precisely for people who think they have. And it isn't just for buy and hold landlords. Short-term rentals often qualify just as well, sometimes even more so. 5 myths, all 5 gone the moment you actually look at your own numbers, instead of somebody else's secondhand opinion or something you got off of social media. I've got another one lined up for you next week. The topic's still coming together as I record this, so you'll see exactly what it is right here, same time, next Tuesday, same as always. If there's a topic you want me to tackle in future episodes, please let me know. Tell me what's kept you up at night on your own tax return. Remember, tax evasion is a crime, but tax avoidance is mandatory. I'm David Wiener, Mr. Cashflow. See you next Tuesday on the Tax Strategy Playbook.
Thanks for listening to the Tax Strategy Playbook. If you found today's strategies valuable, be sure to subscribe, leave a review, and share the show with someone who wants to play smarter with their money. You'll find more resources, tools, and expert tips at taxstrategyplaybook.com. After all, it's your money. Keep more of it.